Hi guys, how are you doing? This is Chandeep Chhabra at Gurli, and for today's kind of blog or the video, you can say, I'd like to thank Rachel. Now, Rachel is one of the visitors at Gurli, and she wrote to me a few days back in saying that if I can post some more articles and videos like the ones that I've posted, especially related to financial modeling. I want to take you through this case. In this case, I have a company named India Online. That's just a dummy name. So we'll discuss about the business of India Online and what India Online does. Let me just kind of take you through the first slide that I have here. Okay. So what India Online is doing is that India Online is actually an online marketplace. It's a tab application, and the application is meant for students. Now, what the students can do is they can log on to the application and they can buy question papers online. Now, who's going to provide the question papers? The coaching institutes are going to put their question papers on the application, and they will be in turn available to sale to the students. And all of this is kind of being facilitated by India Online, which is the tab application. Now, how will India Online make its money? Obviously, it's simple. So whatever transactions happen between the students and the coaching institutes at the platform, India Online will make about 20 to 30% margin. That's the kind of model for the business, and they have some projections here. So about so many students growing to so many students, and this is the kind of revenue that they will make. If you don't know what lakh means, lakh is 10 raised to the power 7. 10 raised to the power 5. I am sorry about that. And to do this kind of business, the company is seeking investor support to raise about $500,000 of capital that the company is going to use in three areas, which is some investment in the IT infrastructure, some investment in funding the initial losses of the business, and then some branding and marketing. So the fund that they are asking for is going to be needed in 2 years, which is financially 14, financially 15. And let's just go and see some more details about the revenue of the company. So I have a whole lot of slides here, but I'm not going to discuss all of that. Let's just see the revenue here. So this is the revenue of the company. The company is actually making revenue on three lines. The first one is they're making revenue through the coaching institutes, and then they're making revenue through dedicated student transactions, and then the open platform transactions. So I'll explain what they mean. So one-time registration is something like the business or India Online, you can say, went to the coaching institutes and they said that, okay, we have this great application for you. You can upload your question papers, but we're going to give it free if you come with us pre-launch. So we are launching on kind of this on this date, and if you come with us on pre-launch, we're kind of giving it to you for free. But if you come with us, if you upload your question papers post-launch, that we're going to charge you some one-time registration fee. So how much would that be? What would the fee be? It's going to be about 250,000 Indian rupees. Now then, for all the institutes that sign up with India Online and upload their question papers on the tab application, we are assuming that about 40% of their student base is going to shop through us for all the question papers, and their annual average card size is going to be different in tier 1 and tier 2 cities. It can also depend upon the number of students and the class of the institute. It's going to be about 1500 to 1000. These are just assumptions that we have taken based on the intelligence that the company has gathered from the market. And obviously the student can be coming from anywhere in the country, not necessarily through the coaching institute. So there's an open platform, and all the students that come from the open platform kind of forms the final line of the revenue. So three lines of revenues: one-time registrations for coaching institutes for those who sign up after the deadline has passed. Then we have student transactions from the coaching institutes. These are students which are studying in those coaching institutes, and then finally any student pan India can log into the application. They can kind of buy. Now that's the kind of revenue here. We have some cost elements here as well. So this is the cost. So obviously the company is going to hire some salespeople, and they're going to hire an IT team for the sales and support. Sales team is going to go to the coaching institution, and they're going to approach and sell the tab application and kind of invite the coaching institutes to come on and come onto the tab application and upload their question papers. And the IT team is going to provide all the IT support. Marketing efforts, that's pretty explanatory. Shopping allowances to boost initial sales, to kind of encourage the students to buy more and more things on the platform. They're going to obviously provide some shopping allowances like freebies and stuff. And then finally they're going to invest in servers and IT infrastructure, and obviously the rent and the admin kind of take some cost. So this is how the cost is looking like, and I'm just not going to discuss any more things with you. I just kind of want to jump into the financial model and show you how the financial model is going to look like. So this is the financial model that I have made. I had not made right now, kind of made some months ago. I think it's more than a year or so. So this is like a one snapshot of the model, what the model is talking about, and the revenue is being compared against different parameters here. So you can compare the revenue against the EBITDA, you can compare it against the EBIT and the PAT. These are three profitability measures. I'm not going to delve into finance here, just kind of showing you how I've made it. And these are students transacting on the platform. So all these are infographic icons, but they are dynamic. So if you make any changes in the model, these numbers are going to update. So as of now in 2014, we are expecting about 1.4 lakh students which are going to be transacting on the platform, rising up to about 65 lakh students which are transacting on the platform. So the projections look good. The bars look pretty good, and it seems like the company is making a lot of money, at least on the spreadsheet. And to do all this kind of wonders that the company is projecting, the company needs money. Okay, so the company is saying that in 2014 I would need about 391 lakhs in 2014. So if you want to go further into the bifurcation of 2014, you can just click on this radio button, and this shows that how are the funds being applied. So the green one is investment in marketing, then you have cash from operations, and then you have investment in IT infrastructure. So if you see that the total of these three leads to this. So if you want to know that how is 85 lakhs requirement coming in the year 2015, you can just click here and it kind of shows that this is the breakup of 85 lakhs. So although you are cash positive, this is the positive number, which is cash from operations in year 2015, but you're making heavy investments in marketing here, and some investment here in IT infrastructure. So, and that's the reason why you kind of need funds about 85 odd lakhs. So this is like a one snapshot dashboard, you can call it, or a snapshot of the entire model. I'm just going to take you through the input sheet. This is my input sheet. Now I'm just going to let you know that this input sheet has all the inputs, or I'll say about 90-95% of the inputs that I have assumed, or the assumptions that I've taken in the model. So if you just take a look here, these are some general assumptions that I've made, like what is going to be named the project, the model start date and the application start date and stuff like that. Some information about the revenue, that how much revenue are we going to earn, some macro assumptions, some cost stuff, the manpower cost and stuff like that, some other cost related stuff. These are going to be capitalized, and some balance sheet assumptions. So all the assumptions that I am assuming in this model, I'm taking it here. Now this looks fairly detailed for a startup company. I'll tell you the reason why. Now you would kind of delve into a lot more detail if you do not have any history of the company. So if you would have had financial data of the past years, then obviously you could have used that data and made some conclusions out of it, and those would have led to the future projections of the company, that how the company is going to do in the future. I see that the company has done this much in the past, so it obviously makes a lot of sense that the company is going to do this or that in the future. So that's kind of more logical. But if you do not have anything that is kind of pertaining to the past, but then obviously you kind of have to delve a lot more into detail to understand what the plan is about the business, and how do you actually want to take it forward, and are the things that you're assuming about the business, are they in the first place correct or not, are they viable or not. So you kind of delve deep down into assumptions. Okay, so that's the reason why it may kind of look fairly detailed for a startup company. Okay, so I'll just tell you that how have I kind of drawn this. So most of the things that you're seeing here are in blue, and in financial modeling, if you see that's a general thing that I'm telling you now. In financial modeling, if you see any number or any input which is in blue, that means that this is a hard punched number. Okay, this is not through a formula. So if you just take a look at the formula bar here, most of the things that are just hard punched. So if you just see they're just numbers. Okay, these numbers I have manually entered those numbers, and kind of giving the user of the model a leeway to change the numbers in the financial model would change itself. These are, you can call them the drivers of the financial model, if so to put. Okay, now if you just take a look here at the general model assumptions, this is the project name, you have the model start date, I'm starting the model on this date. The application is launched at this time, 7th of August, so this is pretty away, and maybe I can just say that I am launching the application on 15th November 2013. Now this would obviously impact because I've preponed the date, and now the company is going to be present in the market earlier, and you're going to start making the money earlier. And this obviously, if you're starting the money earlier, the funding is kind of going to come down a bit. So if you just see here, the total requirement of funds have come down here. Okay, so the model is kind of interlinked everywhere. Okay, this is some tax rate and stuff and all of that stuff here. Now the revenue is the most important part of most financial models, I will say. So if you ask me that in how many cases have I seen revenue not being a very important or a very detailed part of the financial model, I will say none. In all the financial models that I've worked in my career, I have always seen a lot of stress on the revenue, that how are you calculating your revenue. So I have a lot of assumptions here. The company's kind of opening businesses in tier 1, tier 2 cities, and they're kind of targeting two types of institutes, class A and class B institutes. Some good institutes which have a lot of students, and some bad institutes or an average institute which do not have a lot of students. So, and this is their maximum and minimum number, and this is how they're going to reach that number, these many quarters that they will take to reach that number of students, percentage catered, this is what they're assuming, some growth rate, some registration fee that they're assuming, how much the student is going to spend in different cities, and what's the growth of the spend, and some information about macro assumptions about how the students are going to spend, which are outside the institutes, and some other information. And then I have some cost variables here, defined in terms of manpower, what is going to be the CTC, what is going to be the growth, how much team size are you expecting, and I've laid down the assumptions neatly here, and everything is kind of kept here. Now I just want to show you the revenue sheet, how the revenue sheet is made up of. So okay, I'm just going to go here. Okay, now this is something called as an indicator or a counter. Now because I'm working with dates, and I have the leverage to shift the launch of my product. So let's say if I shift the launch of my product to today, let's say I am launching the product today, or launching my application today. So today is 10th of August 2014, if I press enter, I am kind of postponing the launch of my application, and which is severely going to affect my revenue. So if you just see that all of this has become zero, launch and operations, so this has become zero, and I finally start my operations, and the launch kind of starts here and the operations kind of begin from here. So and if you just see in this quarter, I have worked for about 51 days in this quarter, and then I kind of start working for the full quarter. So the model is kind of interlinked to this timeline, and I'm just going to restore that back. Okay, so the model is kind of linked to that timeline, this timeline, and you can play with it, and you can kind of postpone or prepone your launch date, and the full financial model is going to kind of work around that. Okay, then some assumptions that I've made about tier 1 cities, how many cities I'm going to target, and then tier 1, tier 2 cities, and then the different class of institutes: tier 1 cities and class A institute, tier 1 city class B, tier 2 class A, tier 2 class B. And this is how I'm expecting that the institutes are going to come. So they'll start from as low as about 2 institutes, and they'll kind of reach up to 7 odd institutes, and they'll kind of start about 2 institutes and reach as high as about 14 institutes. That's how they're growing. Then I've kind of done some calculations here for the column counter. These are just to know that actually when am I kind of launching my this is kind of matching the quarter end to this quarter as to which quarter is falling when. So once you just take a look at it, it'll kind of be a little more clear to you that what am I doing here. I'm just trying to map the quarter end with this quarter. I'll just kind of explain the reason in a while. Why am I trying to do that? And then I kind of have like a column, like a counter for my institute. So let's say, for example, I'm okay, one second. Okay, so let's say, for example, in December 13, I'm just trying to match this date with this date, and if at all I'm kind of starting in this quarter, then I start with nothing. I start with the lowest, about 2 institutes, and then I gradually grow up to 7 odd institutes. And then in this financial quarter, which is 31st March 2014, I again start with about 2 institutes, and I go up to about 7 odd institutes. So you kind of start small when you approach a new city, and then you kind of grow. That's how the logic is. So if I'm kind of starting the business in a new city, I do not know the dynamics of the city, and I kind of start small in that city and kind of grow up in that city. So this is the kind of counter that I've made for each class of the institute. So class A will have this counter, and then class B will have this counter, and then class A in tier 2 will have this counter as to how many institutes you're starting and how is it kind of spanning up, and class B will have this counter. And then finally, I'm going forward, and I'm kind of calculating the revenue on this. And you also have the options of kind of hiding all this calculation, because this is kind of supportive calculation and not so important, so I can kind of hide it. Okay, and by clicking the plus sign again, I can just see the workings here. Okay, so I have class A tier 1 institutes. As I told you that in the presentation we just saw that we have 3 lines of revenue. The first line of revenue is the students which belong to the institutes and are buying from us. So these are those institutes where the students are kind of buying. So all I'm doing is right now I'm just calculating the total number of students, the total number of institutes that we are reaching. So we are starting as low as about 2 odd institutes and reaching to about 84 institutes in tier 1 cities. And so have I calculated for class B institutes and class A institutes in tier 2 cities and class B institutes in tier 2 cities. So once I get the total number of institutes, total number of institutes, I can simply multiply it to the number of students that I think from those institutes are going to be buying my product or buying the question papers, and I will get the margin on those question papers. So I finally get the revenue here, This line is the revenue. This line is again the revenue. This is the total revenue that I get from class B institutes. Then this is the revenue. Sorry. Okay, this is the revenue from one-time registrations. So those one-time, remember those one-time registrations where the institutes will have to pay an average of about 250,000 Indian rupees for registering onto the platform. These are those revenues. And then finally, there are kind of coming from the institutes, and this is the kind of number of institutes, number of students that we're going to target. And finally, we kind of get the revenue from the students. And obviously all of this revenue is not ours. We have to give some share to the coaching institute, or rather a lot of share to the coaching institute, and we keep a margin. So we are keeping about 20% here, and we are giving 80% to the business associate here. So when we are new in the company, I have assumed that the margin is going to be 80%, and when we kind of are fairly old and we have strongly established, so we have a better negotiating power. So I'm saying in the final end of the projection period, the margin is going to drop down to about 70% that we are giving to the coaching institute. Now these are so this is kind of the macro assumption here. So since we are a company, we are dealing into helping students buy question papers for different competitive exams that happen in India. So these are the competitive exams, and these are the total number of students that we've assumed kind of that sit for these exams, and this is how the students are going to grow in the future. And even if we're saying that we capture a little share of those kind of big pie here, we're going to be making a lot of money. So this is the money that we make in tier 1, and this is the kind of money that we make in tier 1 and tier 2, and this is the total. Now this is the money that we make in total from open market operations. This is the total number of students, and this is the money that you make from open market operations. And then finally you get the total revenue. You have the registration fee revenue, you have the student revenue, and you have the open market revenue. This is the kind of total money that you make quarter by quarter. When you're starting up as a new company, you obviously are interested in how much money and how are you making that money. So even if when you're making a financial model for a startup company, my strong suggestion to you is that focus on the revenue more than anything else in the financial model, because whenever you show that financial model to any investor, the investor also will be asking for the revenue. Especially the startup company focuses more on the revenue because the investor has got nothing else to build confidence into the company's business model. The company at least has the capability of growing very fast. This is the first proof of the business that you can give to the investor. Whenever you're trying to deal with banks or stuff like that, I'm not very sure if revenue is their key parameter or one of the main parameters that they would like to check. They are more interested in, is the company making profits or not? Is the company healthy enough that they will be able to return the loan that I give to them, or are they going to be healthy enough in the future? Can they return my interest and the loan or not? That's the kind of thinking that the bank will have, which is very contrary to a private equity investor or a venture capital investor. Okay, then we move on to the cost item. Here I have the cost, again the same counter here, and we have in the cost is pretty simple. So you have some salaries that you want to give to the sales team, some salaries that you want to give to the IT team, some salaries that you want to give to the other people around, and some variable cost and other stuff like that, and some rent and stuff like that. So you kind of get the total cost here, which is not too complicated. I have kind of defined everything in the input sheet, and all I'm doing is kind of pulling the numbers here and adding a bit of growth factor, because the inflation and stuff kind of affects the cost, and the cost goes up quarter by quarter or year by year. Moving on to a couple of more things that I have in the financial model. So the revenue is done, the cost is done. I want to show you a couple of workings that I have done. So this is the working for the sales, IT, and the HR team. Some Since you're hiring people and you want to kind of invest in computers and you want to kind of invest in the IT infrastructure as well. So obviously you will hire, kind of buy some, invest some money in the information technology. So, and which is not going to be your cost, which is more of like a capital expenditure, which is going to appear in your balance sheet. And obviously the company is doing a lot of marketing. So if you just take a look here, marketing cost during that year, we start from about 100 lakhs, that's nearly about 10 million, and you reach about just the total I think is about 800. Yeah, I think it's 800. You can just see here. So the company is nearly spending about 80 odd million in just the marketing efforts. They're really going, heavy on marketing. So if you're doing such heavy marketing, you don't want to kind of put all of that cost in your income statement, because what is going to happen is that if you're making 100 in the first year and your marketing cost is alone 100, then your profit kind of jumps down. And you can treat marketing cost as an asset, because it is going to give you some benefit, some benefit in terms of sales being increased, or some brand equity, or some brand being established in the market, which you're going to reap in the later years. So what I've done is I've kind of capitalized heavy marketing cost and year on year. So this year the closing balance is this year, and this is what I have kind of capitalized. Okay, moving on to some financials. This was majorly the assets and their depreciation. Now moving on to some financials. So now financials is your financial statement. So I'm just going to go to the top here. Okay, so this is the financial statement. So this is the kind of summary of how much money you're making through the 3 channels, and this is the summary of the entire cost, which is, I've just picked it up from the revenue and the cost sheet. Now if you just take a look at the model closely, this model now turns to be an annual model. So you have annual year endings, but whereas when you were working in the revenue or in the cost sheet, our model was a quarterly model. So when I shared this model with you, you might just want to check out the formula that I've used to kind of correctly total all the money or the cost that we are incurring in the relevant financial year. Okay, and this is the kind of money we are kind of making or losing. So here we are negative, we are having a loss here, and then finally we kind of reach to the PAT level, the profit after tax. We have some balance sheet, so whatever loss or profit we're making, we kind of adding up to the reserves, and we're just having some application of funds here. Application of funds as in where are all your funds going? So our funds are going into fixed assets, we have some current assets, and we have some cash. So I think our cash actually comes in the after 2 years from now. So till then we actually have no cash left in the balance sheet. We are kind of consuming everything. And then finally we come to the cash flow statement. Now this is pretty important. So I have to tell you that how did I reach to this figure? So if you just take a look at the snapshot, in the snapshot I'm kind of asking for a very little money here and about 283 lakhs here. So how did I reach to this 292, which is the total of the money that I need in 2 years? So how did I reach to this figure is the question that will be answered through the cash flow statement. So you just take a look at the cash. So here from the operations we make no money, it's a negative. And just take a look at the same year, we are kind of investing in 2 assets, which is your infrastructure, IT infrastructure, and then you're kind of investing in the cost of marketing, heavy marketing, and then you kind of, the money is going out. So this is the kind of money that you need in the first year. This plus this is what you need in the first year, and this is what you're going to ask the investor in the first year. And then probably in the second year you're making some money here, okay, which is very good. Your cash operations positive, the operations have started to give out cash to you, but you still need a lot of investment in the marketing efforts and in the IT investment. So you need about 400 here and about 56 here. That makes it 456, which is still more than what the money that you're making, and you still have a negative balance. And because you have a negative cash, there's nothing called as negative cash. This is the kind of cash that you will ask to the investor, and then you're good to go. You are making a lot of money here through operations, and the money that you want to invest into marketing and into assets, you can just fund it on your own, and you have some surplus cash left. So on this year and then this year, you're kind of going to ask money, but in this year you have a lot of cash left and you don't ask any money. So this is kind of good for the company. The company is kind of turning cash positive in the 2 years to come, and you kind of link it that to your snapshot. So this is how those numbers have come. And finally, in the last sheet, I have a couple of charts available and stuff like that. So these are just kind of rough work that I've done. So this is the financial model, and I would just like to also share with you that how much time did I take and what's the process of making this a financial model like this. So you should spend a lot of time with the promoters and the directors of the company just to get a real understanding of how they think that the business is going to run. Okay, and you take down every point that they're saying and over a meeting, and that's how you get some understanding of what they're trying to do. And then you kind of validate every point of theirs as to if this is feasible or not, can this really be done or not, and then you pose questions to them. So in this kind of deliberation, you kind of get an understanding of what is the business and what are the kind of drivers of the business. And then once you have all the assumptions and all the things of the business that they're trying to do, you kind of put it together in a financial model. And you start with, the first thing that you start with is revenue. So you first do the input sheet, and then you kind of go on to the revenue and you build the revenue, and then you build the cost, and then you kind of finally build the financial statements. So that's how you should go and build the financial model. Once you get really quick at financial modeling and you have all the data with you, I don't think that it takes anything more than a couple of hours to make one full financial model. And obviously the financial model goes through a lot of changes and iterations, and then the real model comes out which the company is looking forward to or the company agrees to. And then you put all the story together in a presentation. So I can just open the presentation for you. So you put all the things together in a presentation. So you can just take a look. This is the presentation that I've made, and I've put everything together, and you write the whole story down here, because nobody is really going to kind of look at your financial model in the first go. They would rather be interested in the presentation and how have you shown the business. So okay, so this is the financial model and the presentation that I've shared with you. I hope you like this session. So if you have any questions about this financial model in particular, you can just put it down in the comments, and I'll be very happy to solve them for you. Well, thank you so much for being with me, and do take care of yourself, and thanks once again to Rachel. Take care everyone, and goodbye.